Right now, something important is discussed, and the financial system millions trust is quietly failing beneath layers of hidden structural risk. The disturbing question is, could the 2026 market crash destroy wealth for most, or secretly create fortunes for the prepared? History shows crashes are rarely random. They result from decades of ignored imbalances, leverage buildup, and speculative mania compounded exponentially over time. Central banks printing money, governments accumulating debt, and markets mispricing risk consistently have created a hidden financial powder keg ready to ignite. Major institutions operate on assumptions of stability, ignoring growing fragility that can collapse suddenly with even a minor trigger event. Key figures, hedge fund managers, and institutional investors have quietly positioned themselves to exploit these imbalances before the inevitable crash unfolds globally. Rising asset prices fueled by low interest rates and endless liquidity. Injections created illusions of wealth and security across all major markets. Equities, real estate, and commodities surged, disconnected from real-world productivity, while derivatives and leverage magnified exposure across multiple interconnected markets. Artificial stability gave the false impression that market corrections would be mild, lulling ordinary investors into dangerous complacency about financial security. Breaking points often appear minor, triggered by interest rate changes, unexpected defaults, or geopolitical shocks that cascade through global markets instantly. In 2026, overextended positions may reach critical thresholds, forcing liquidations that amplify volatility and trigger rapid, uncontrollable market reactions everywhere. Early cracks may appear subtle, but margin calls, automated trading, and interbank exposure will propagate panic faster than anyone anticipates. The fallout extends beyond headline losses, affecting retirement accounts, corporate portfolios, and global confidence in financial systems simultaneously and profoundly. Banks, pension funds, and corporations will reevaluate exposure while liquidity dries up, producing cascading failures reminiscent of historic market collapses repeatedly observed. Delayed recognition of market fragility amplifies consequences. 2026 will mirror historic patterns where panic spreads faster than interventions can respond. Failed fixes are inevitable, as central banks inject liquidity and governments issue temporary bailouts without addressing underlying structural weaknesses. Effectively, over-leveraged positions, mispriced risk, and systemic interconnections mean temporary solutions postpone reckoning rather than preventing systemic collapse permanently. Modern parallels show retail-driven market disruptions, short squeezes, and algorithmic trading can overwhelm even the most sophisticated financial institutions suddenly. Social media accelerates feedback loops, making market sentiment an increasingly powerful driver of volatility and amplifying crashes in real time unexpectedly. The 2026 crash will expose weaknesses in stocks, bonds, commodities, cryptocurrencies, and derivatives, leaving virtually no market untouched or insulated from shocks. Global debt exceeds $300 trillion, leverage ratios remain historically high, and derivatives exposure dwarfs economic output, revealing extreme systemic vulnerability to collapse. Liquidity gaps, settlement delays, and thin markets create perfect conditions for sudden, dramatic price movements that punish the unprepared and reward the prepared. Repeating patterns are consistent. Calm markets breed complacency. Complexity hides risk. Minor shocks escalate. Panic spreads, and interventions fail repeatedly every cycle. Each market cycle shows the bigger the buildup, the more violent the correction, and the greater the opportunity for prepared participants strategically. Excessive leverage amplifies losses. Behavioral herding amplifies volatility. And global interconnections transmit shocks instantly, exposing institutions to unpredictable cascading failures quickly. Structural fragility spans multiple markets. Equities, real estate, bonds, and commodities are interconnected, allowing shocks in one sector to cascade rapidly elsewhere. Automated trading accelerates feedback loops, magnifying volatility and forcing participants to react instantly or face catastrophic financial consequences without warning. Recognizing patterns before they unfold is critical to identifying opportunities while unprepared. Investors experience devastating losses and panic-driven sell-offs worldwide. 3 takeaways are clear. First, structural fragility exists even in institutions considered too big to fail under cascading shock conditions globally. Second, opportunity arises in chaos. Market crashes create asymmetrical risk-reward scenarios where the prepared can generate extraordinary wealth quickly. Third, timing and strategy are essential. Acting too early or too late can dramatically alter financial outcomes in volatile markets permanently. The warning is stark. Systemic weaknesses in 2026 will be exposed, and complacency will prove extremely costly for the unprepared investor. An open-ended question remains. Are you prepared to navigate the chaos, or will you be swept aside while others profit massively? Those who understand liquidity, leverage, market psychology will thrive, while passive participants may face permanent financial destruction without recourse. Recognizing these dynamics allows investors to monitor risk, hedge exposures, and act decisively when profitable opportunities emerge during market chaos. Observing debt levels, margin trends, and market sentiment provides insight often hidden from the general public until crises become undeniable. Crashes do not wait for preparedness, but preparation determines outcomes and allows capital to flow strategically during periods of extreme market stress. History shows financial crises are predictable in pattern, if not timing, allowing those who observe structural warning signs to capitalize strategically. Financial psychology, structural leverage, and feedback loops create predictable cycles, each offering windows of opportunity for decisive investors with strategic foresight. The 2026 crash could make you rich if you understand leverage, margin calls, liquidity gaps, and behavioral feedback loops driving market movements effectively. Panic and disorder destroy the unprepared, while disciplined, knowledgeable investors positioned in advance can capitalize on chaos and volatility decisively. Timing, research, and risk management are critical allies when market structures are stressed and volatility reaches historically unprecedented levels simultaneously. Excessive confidence in stability is dangerous. The largest banks and most secure portfolios are not immune to cascading market shocks globally. Those who recognize opportunity during the early stages of a crash can allocate capital efficiently and achieve outsized returns relative to risk. Misjudging timing or exposure can result in devastating losses. While strategic positioning during chaos can generate transformative financial outcomes permanently, the market will not signal warnings clearly. Understanding systemic vulnerabilities and behavioral dynamics is the difference between profit and ruin decisively. Investors must act before liquidity dries up, margin calls cascade, and panic spreads, because reaction after the fact is rarely profitable. Recognizing interconnections between asset classes is critical to predicting how shocks propagate and where opportunities for profit will arise strategically. Automated trading, high-frequency systems, and global connectivity accelerate market movement, making early detection and strategic action more essential than ever before. Behavioral dynamics amplify technical shocks, creating self-reinforcing cycles that compound losses for the unprepared while rewarding strategically positioned participants heavily. Crashes are not just financial events. They are social and psychological phenomena amplified by human emotion, perception, and reaction to market stress. Opportunities arise when panic overwhelms rationality, creating asymmetric risk-reward scenarios that can be exploited through knowledge, discipline, and strategic timing. The 2026 crash will create asymmetric opportunities where capital allocation, research, and positioning will determine winners and losers decisively in volatile markets. 3 takeaways emphasize strategy. First, understand structural fragility. Second, exploit asymmetric opportunities. Third, prioritize timing and disciplined risk management continually. The warning remains clear. 2026 exposes systemic weaknesses, and the unprepared will suffer massive losses while the strategic capitalize on volatility quickly. Open-ended thought. If the system fails again, will you have positioned yourself to benefit, or will you be caught unprepared and powerless? Recognizing liquidity trends, leverage, and behavioral signals allows early action to protect capital and exploit opportunities for wealth during turbulent markets effectively. Historical patterns indicate that preparation is essential. Those who observe warning signs can convert disruption into life-changing financial gains consistently over time. The 2026 crash could generate wealth for those who understand risk, timing, and systemic exposure, while destroying fortunes of passive, complacent investors entirely. Subscribe now to stay informed about financial warning signs, strategies to navigate volatility, and insights that can turn market chaos into wealth strategically. Understanding early and acting decisively is essential for positioning, capitalizing on market disruptions, and achieving long-term financial growth during crises efficiently.